Keith, good morning.
Good morning. How
How
are
are
you
you,
doing?
man?
Doing
I'm
well,
good.
man.
I'm coming to you from my spacious hotel room in Austin. It's not it's smaller than my closet at home,
Okay.
but it's all good. How about you? Where are you?
I'm in the Demuso headquarters. It's close to the house. We haven't been going into the Gelt office, and it's pretty much a lot further away. So I'm like, you know what? If I need a little quiet space, I go to the Santa Monica Demuso office here. So,
Nice, nice. Well, Santa Monica is a good place to be.
yeah, man. Yeah.
Well, hey, I think we've only got 30 minutes, but I thought it'd be fun for you and I to catch up. We've caught up a few times the last 2 years. You're my real estate investing guru. Call me anytime on tech, but I call you for real estate. But give folks a little bit of sense of your background, sort of, where'd you grow up? How did you get into the business you're in? And then I've got all kinds of questions for you.
Yeah. So if I'm going too long, just stop me. But yeah, I grew up here in LA. I'm born and raised Angelino, pretty rare kind of breed. Always been very entrepreneurial. So I came from a family where my dad never had a real job. I never had a job. I literally, learned about investing and business growing up. And one of my first, business ventures in high school, I started like going to downtown LA to jobbers, and I bought all this this merchandise, these leather jackets that were called irregulars. They had little tiny blemishes on them.
Yeah.
And I picked them up for like $10 a piece. And then I sold them for $100 a piece, which the people thought they were getting a great deal because the ticket said $300 or $400, whatever it was, like these Perry Ellis lambskin leather jackets. So I learned early on, about making money on the buy, being able
hustling.
to help and profit. And yeah, I just, was investing in the stock market early age, and real estate sort of fell in my lap. My cousin came to me in December of 2008. So sort of a crazy time. Market was in free fall. There was tons of REOs, and we picked up a small 4-unit building in the Central Valley in a city called Bakersfield, which LA people, we don't even know where Bakersfield is, man. But it's an industrious town built on oil and agriculture. And we were driving up there every week. And that's where we got our start, in Bakersfield. Yeah.
It's funny how many people. I have a good friend of mine whose father is, older than us, and he got into, he owns a ton of multifamily real estate, and he same thing. He bought one apartment when he was in college, and today he owns, I don't know, probably thousands.
Yeah.
And so why does your business, why does it, I mean, how much of it's inside baseball and knowledge and things that you've learned over time, and how much of it is luck and opportunity and innovation? I mean, in our world, in venture capital and tech, so much of what happens really quickly, right? Somebody comes up with an idea for a new product, they can build that company, particularly in today's world, in 12, 18 months, raise capital, boom, boom, boom. It strikes me as real estate's a much longer term game. Can you talk a little bit about, I don't know, does that resonate with you? Does it not resonate?
Yeah, I think it's sort of the tortoise and the hare kind of thing. I think real estate is slow and steady, decades over decades of compounding growth, and there's not much innovation for the most part. So, it's hard to lose if you buy a good piece of real estate in an area that's improving and growing, and you take good care of it. And, with just natural inflation and rent growth, you're going to become a, whatever you want, a millionaire, 100 million, whatever, over a long period of time. If you stick at the game, can keep rinse and repeat. Anything I've ever sold, anything my mentors have ever sold, they've regretted selling because it's gone up so much more in value over the decades. It's so different than in like a tech company that a competitor could out innovate you, and you could turn to a zero really quickly if you don't stay up, stay with the times and ride the right waves and innovation. Yeah. It's not a winner takes all market. Like, there are literally probably millions of people in the US that are multimillionaires from real estate. And in tech, I mean, yeah, you could have jobs in tech and invest in tech, but I think there's just so much more wealth in real estate than in just tech jobs, let's say, in the tech world.
And maybe winding back the clock a little bit. So you buy this property in Bakersfield. What's your model? Talk to folks a little bit about how your fund model works, or how your investment thesis work, or let's assume folks listening today are mostly tech or venture and know very little about investing in real estate as an asset class other than maybe owning a home. You talk a little about how you guys work and what you look for and where the opportunities are a little bit. I know that's probably a multi-day conversation, but condense it for us.
Yeah. So when we started, literally we had no money, so we literally went to mentors and tried to figure out as much as we could. And we learned by doing. We read as much as we could, but literally the best education was doing. And for the last 13 years, we started with one fourplex. My cousin's father was really hands-on with showing us how to deal with the general contractors. My dad was hands-on being an attorney, knowing how to deal with the contracts and dealing with the broker firm and the negotiations. And then, like, literally we started with one fourplex and then another. And eventually we started putting like groups together. They're called like syndications, to buy larger and larger apartment communities. So like
almost like an SPV, right?
essentially in December
Yeah.
2009, we bought our first apartment community. It was 78 units, also in Bakersfield, a market we knew well. We put together 8 investors. We raised like 1.3 million of capital. Our acquisition fee, which was, I don't even know, 150 grand, we just rolled it back into the deal, didn't even touch that. And literally we bought this $3.9 million, 78 unit building in Bakersfield and put in a few $100,000 in renovations, like upgraded. It had 2 clubhouses, one that was just shuttered and closed. We transformed that into a gym, which is a big amenity people like because they don't have to go pay for their gym membership. We added, we just started doing interior renovations. We replaced the parking lot, just made the place aesthetically nicer, a better environment, safe environment for people to live, and lifted rents in the process. And we've been doing that and rinsing and repeating it over and over and over with one apartment community at a time, bringing in one new investor at a time. So yeah, most of our investors are, like you said, they own their own home, and that's pretty much it. Maybe they own, some stock in a publicly traded REIT or some of these private REITs. Maybe they've invested with a sponsor like us, but essentially, like we provide we're your like real estate, outsource office where, nowadays, if you wanted to buy, let's say, a 10-unit building in LA, that's going to cost you $4 or $5 million. So you got to plunk down $1.5 million. Whereas come to us, you put 100 grand in 15 deals, and you don't have to worry about anything. And we're buying large institutional quality size properties, 200 units and up, with professional on-site management, maintenance, and this is all we do. So literally, it's like very hands-off, and you get all the benefits of the depreciation and the ability to exchange with us. And there's a reason why people that have wealth that want to preserve it over a long period of time invest in parking and real estate.
So if I understand the model, just very simply, identify properties you think are in good geographies or reasonably good geographies, but which is, by the way, I want to ask you about that because you guys have properties all over the country.
Yeah.
So that's 1. 2, you go in, make some improvements. 3, you bet on the long-term value appreciation of the building, as well as appreciation in the rents, increases the value of the business. And then there's refinancing opportunities, 1031 exchange opportunities, et cetera, et cetera.
Right.
Fair?
Yeah.
Okay.
We don't do it in a fund model. So in VC, like you do, I think it's great to be in a fund model because you have a lifespan of a certain amount of time and you reap your rewards and distribute capital back. In real estate, you want to just let it keep compounding. Yeah. Don't sell and pay those capital gains. And then you have something called recapture for all the depreciation you've taken. You're literally, if you sell, you want a 1031. If you don't sell, just keep pulling out money, tax deferred cash, refi, cash on cash dollars that come out, cash out refis. And literally you have those dollars to reinvest in other things. And that's the way to play the long game in real estate. That's why I don't think it should be done in funds or, it should be just deal by deal.
Yeah. I mean, interestingly, I think what you're seeing is a lot of folks in our world, Sequoia came out recently and publicly announced what they've been doing for a long time, which is, I always like to say the long-term, companies staying private longer for us and sort of forcing us to hold our positions is a feature, not a bug.
Correct.
Right? There's nothing, my partners and I were just talking this morning, we distributed some of our Airbnb stock. And I said, I can't wait to own it in 15 years when I come visit you guys, in your retirement or whatever. But
yeah,
I do think people are getting more acclimated to the idea that real estate investors have had for decades, which is buy and hold. The value appreciation in our world too is so significant now that it does have some of the same characteristics that you guys have seen in real estate for decades now.
Yeah.
What's
smart for sure.
Go ahead.
Yeah, just hold on to like Airbnb, generational kind of companies. You're in there. If you want to take a little off the table, but keep that thing right, let it ride, let it compound. And, you've seen like companies like Shopify, since they've gone public, have, I don't even know, 30, 40X, whatever. Like, so, I don't know if any of the VCs that went in there, and usually they just sell out and distribute the funds. But like, if I was a VC and an LP, like I would want to hold that and let it ride and not pay the taxes and then just start slowly selling. If
Welcome to my world, my friend.
Yeah, or just borrow against it. Just instead of selling it, borrow against it at 1% or less. I mean, like you could borrow against equities now really cheap. So that's my philosophy of just long-term investing. And if you have a good amazing company with amazing leadership with longevity, just ride it.
Well, unfortunately, a lot of the universe, and including CNBC, which I have on in the background, is catered towards trading, right? Buy this, it went up 20%, sell it. And I always love to tell people I've owned Salesforce since it went public, and I'm like, why would I ever sell it? Mark Benioff is one of the greatest CEOs of our generation. They're in a great category, they're a great team, great products. And so I'm always looking for, Square or any of these companies that when you go public and you just say, gosh, that thing's got a good 10, 20-year run ahead of it, even if it looks expensive at the time it goes out, and very similar to your investing philosophy. And a lot of what you talk about on Twitter is outside of real estate. So you've gone deep in crypto. I know you love talking tech. How, where is that? Does that just come from a place of passion, or is it something that you guys are doing within Gelt, or how are you thinking about that?
Yeah, so at heart, I'm just pretty much an investor, I'd say. So I love investing in public stocks. I love learning along the way. I've learned a lot from my mistakes. You know, most of my mistakes have happened because I learned from my mom early on. She says, you don't go broke taking a profit. But I think that's the worst advice, because you cut your winners. And literally, you know, I bought Tesla in 2013. I sold it a few years later. I had Netflix in 2002. I sold it a few years later. Like, I should have just held on to these things instead of saying, oh, I double, triple, quadrupled the money. Wow. Just like you said, illiquidity is a feature. Market, forget about it. Like, literally monitor it. And then I also learned to like add to your winners too. Like, you know, if you have money coming in, it's okay to pay a little higher price. You don't have to like say, oh, I bought Salesforce 20 years ago or whatever, like, and I can't touch it again because I bought it so cheap. So like over the years, you just keep adding to it. If you love and have that conviction, keep growing that conviction. I've learned to really even add to the winners. Like, you know, so technology companies, like, yeah, I find it intriguing to be, you know, an early adopter, believer in someone, and see their vision and really back them. And so that's why we did some angel investing. We did some micro VC funds. Now, pretty much my focus is on the real estate investment business. I brought in other people to run these, but I have a passion for entrepreneurship, people that see the world differently, that want to do good in this world. And I think, you know, that's how America is great, from entrepreneurs that create these businesses that then employ thousands, hundreds of thousands. Like, that's the job creation. That's what makes America great. And I think we should continue to have capital like the VC that you guys provide to back these the amazing companies that will have a lot of longevity and create, you know, so much value in the world.
Amen, brother. I'm hopeful that you know, it's funny. A good friend of mine I was talking to who lives outside the U.S., he said, you know, it's funny. Everywhere else in the world, they celebrate people who are successful and getting rich and becoming billionaires. He said, in the U.S., I feel like everybody's trying to tear them down. And I said, yeah, I think the numbers have gotten so extreme with Elon and Bezos and things like that, that has changed the nature of the conversation a little bit. But I hope we can shift back to our more moderate approach where we celebrate success, you know, the job creators, because we are in an incredible place in time, I think, where technology is revolutionizing industries, creating a ton of jobs, incomes are going up. But you know, I'm with you. I think we've got the greatest economic engine in history, and I hope we don't screw it up.
Yeah, no, I think you're right with the numbers, how, you know, the hundreds of billions, and it used to be a billion used to be a, you know, very few people on the billionaire list or whatever. But like, I'd rather have Elon and Bezos having these hundreds of billions. Eventually, you don't think they're going to invest? He's already investing it in Blue Origin, and you don't think Elon's going to give it away in a better way and invest it for the future of this human race and to make the world a better place? It's not like he's going to bury it in his grave with him or give it to his children, right? These guys are really going to, you know, they've already changed the world so much. You don't think they're going to do it with their philanthropy also? Like that's why I don't mind as much. Yeah, it's like pretty crazy, and you know, I see people struggling and suffering, but I think capitalism still works, and I think I'd rather have those people have hundreds of billions than, you know, someone else squandering the money. And I'm not going to go into politics, but
Let's not go there.
I don't mind it as much.
I will say one innovation I'd love to see, and I haven't quite figured out how to do this yet, is, you know, if there was a way, and there are some, you know, Mark Benioff famously has his 1% model at Salesforce. I just love to find a way to have some of these successful companies put some of their equity into the community that they've grown up in. I mean, can you imagine if, you know, 5% of Facebook stock was benefiting East Palo Alto and the whole South Bay? I mean, you're talking about $50 billion plus that would have gone into the community, into schools and hospitals. And so somewhere I think there's some room for innovation there with our model of capitalism. As we create these gigantic companies, can we find a way to have some of the economic value? And it does today in an indirect way, in terms of, you know, flooding into the community and businesses and, you know, donations to schools and things like that. But I'd love to see a more direct way if we could ever figure it out. I think it would go a long way towards making people feel like they're getting part of the upside of the capitalism that's happening in their local community.
Yeah, I think if there's a better mechanism, and just, I think generally when this happens, you have an uproar and say, the typical G word, gentrification. It's changed. You know, we want to keep the area the way it was. And I understand the people that get priced out of these neighborhoods, but if there's a way these companies could create more, you know, affordable housing and just build in general, like that's another thing. All these NIMBYs and areas that's what's keeping the prices
in California. It's crazy.
The zoning and the inability to build. And like, you know, people are blaming these tech companies, but in reality, these tech companies, not just the people that work for them, but it trickles down because they're spending the money in the area. It just improves everyone, but it becomes more unaffordable to live. And you have people sell out of those. They say, wow, I bought it for $100 grand. Now it's worth $1 million. I can bring the $1 million to Arizona, live in a mansion. I don't know. I understand where they're coming from, but I agree with you. I think you know, the narratives could change. They could help change some of the local, you know, politics and zoning laws and stuff and allow more building. But definitely I agree with you there.
So I'm going to come back to real estate, but tell me a little about your foray into crypto. You've got a CryptoPunk as your avatar on Twitter. I know you're having fun with it. Tell us a little bit of how you went down the rabbit hole of crypto and what you're thinking about.
I have so much fun on Twitter in general, but like, so I first learned about Bitcoin in like 2013 or 14, and I'm like, you know what, this is really cool. I didn't have as much money then, so I only bought a few Bitcoins, and I'm like, and then I kept buying and buying more as it went up to like 19,000 back, I don't know how many years ago. And because I had the FOMO, which is never good. Don't invest into FOMO. And then I sold it all in book even because I kept buying at a higher and higher price. And then, so I've always been interested and intrigued and staying curious about things that I think have a future, even if it's a small chance that this could be the future. So that's what, and then I learned about Ethereum and I started buying some Ethereum. And then I used that. I saw, you know, I listened to Kevin Rose on this podcast with his MoFi, Modern Finance, and I learned about all these different NFTs and projects in I think February or March of this year. So I bought my CryptoPunk, which at the time was a lot of crypto. It was like $50,000, and I'm like, my wife thought I was a little crazy, but I think, you know, that that whole you know, project has a lot of legs. It's one of the first projects. I think NFTs are here to stay. I do think a lot of them are going to be worthless, kind of zeros, but it's going to be interesting to see a lot of millions of people get involved and learn about, you know, the whole NFT space. There's going to be different use cases that are not even existing today, and new companies that are being formed. I just love the whole energy of, you know, they call it Web3 now, and it's just really cool to see. Yeah, there's going to be people that are scam artists and whatnot, but you can say the same thing about the beginning of the internet too. And you know, it's definitely going to be interesting to see. But yeah, I use the CryptoPunk as my avatar. It sort of stands out. It's a unique community. You know, instead of buying a Ferrari that'll lose value, whatever, and be worthless, I'm going to buy a CryptoPunk. I think
if there are Ferraris for 50,000, I don't own a Ferrari, but
no, but I could sell this CryptoPunk for $500-600 grand and buy his and hers.
That's
Ferrari.
True.
But I don't want to be seen as a douchebag driving a Ferrari. I don't even like Ferraris. I'm a Tesla guy. I want the Roadster. Once I see the Roadster on the road, I'm probably going to go buy that thing. But
the new one.
Yeah, the new one looks sick.
Yeah.
I got my first Tesla in 2013. Literally, I was ready to put the deposit down. My wife's like, no, let's buy the stock instead so we can really afford this damn thing. So
she's the smart one in the family.
She's the smart one. It tripled or quadrupled after a year or two. I bought the 60 kilowatt. It was the smallest one at the time. And then I got the Model X now, P100D, and I have another one on order and a Y. So I'm a big believer in Elon. He made it driving an electric car sexy, cool. Like, it just amazing not going to the gas station for 6-7 years. It's such a chore and you're wasting so much money. Gas is like $5 a gallon now. I smile and laugh when I drive by the gas station.
No, I'm on my third Tesla. I've had one since I think, I don't know, 2011 or 12. And my wife has a Yukon Denali XL, and every time I drive it, I go fill it up for it. I'm like, good God. I mean, you're just dumping $100 bill into that thing every time you fill it up. It's crazy. Yeah. It's such a unique experience to plug in your car at night. And I tell everybody, you wake up in the morning, you have a full tank of gas. It's amazing.
Yeah. I just describe it as like, people are like, oh, it's going to be so hard to do. And I'm like, do you plug your phone in at night? Like, just fucking plug it in.
It's not hard. Once you make the transition, I think one of the biggest barriers to some of the other companies like Porsche, Mercedes, and others, they don't have the charging network. The charging network is a huge part of the value prop with Tesla. I can drive anywhere. Yeah. I can drive to Tahoe, which is a 3-hour drive, and know that there's multiple charging stations along the way. By the way, they show up on the screen. Not having that's hard. If you have people like, oh, there's ChargePoint. I'm like, yeah, I like ChargePoint, but like, it's not that easy to use.
No, and the superchargers are so quick, and he spent years building those out, and I agree with you. And yeah, like, I even though I don't go on that many road trips, maybe 2-3 a year, but it's cool to be able to use them. And now we're finally like, I'm going to go to a full electric household. A lot of people are like, oh, I need a second car that's gas. Like you have one. I think, they have 250, 300 miles of range. Like there's not that many days you're going to drive more than
No.
that. If you do, they have those superchargers along the way. And,
Yeah.
so for
How
sure.
cool would it be? My a Yukon Denali XL. I'm not sure we're gonna have an electric version of that anytime soon because it's a pretty big car.
Yeah.
But like the Rivian, I love the style of the Rivian, the Ford
Yeah.
F-150 electric. I think we'll be there shortly. Hey, let's go back to real estate. So what advice do you have for folks who are maybe earlier in their career? Maybe they own a home, maybe they don't, but they want some exposure to real estate. I think, particularly in today's market where we've had a 10-year market run, tech is at all-time highs. People are super exposed to the public markets. They're looking for other things, which I think is part of the allure of crypto, to be honest.
Mm-hmm.
And maybe they're thinking, gosh, I should have some exposure to real estate. Do you have advice for folks who are in their 20s or 30s or just starting out as investors and ways to think about real estate?
Yeah, I'd say just like in any investing, the best time to start is now. You can never time the market. Like I always tell people, let's say you bought in 06 at the height of last cycle. As long as you kept your leverage relatively low, even if you bought in like Phoenix, Vegas, these markets that got crushed, if you're able to withstand through that 09, 10, 11, the values now are so much higher. The rents are so much higher. You got to play the long game. And I'd say if you're investing with sponsors, invest with sponsors that have longevity, track record, will be a good fiduciary for you, and not into just quick fixing and flipping kind of thing. You want to align yourself with a sponsor that has your back for the long term. If you're buying your own things, you just got to realize it is illiquid. You're gonna have to park a lot more of your own capital if you are buying a 1, 2, 3, 10 unit, whatever, like instead of putting a little in a lot. So you just have to, I always look at my whole portfolio, how much cash, how much stocks, how much real estate. The illiquidity is a feature, not a bug kind of thing. I really believe in that. And that's why so many people are wealthy over real estate, because it forces them to hold. Even most Americans are wealthy because of owning their homes long term. Like that's one of their main investments is their home, because it's gone up in value so much and they have lived in it, and it's appreciated like crazy. So just I'd say, if you want to do it on your own, that's great. There's benefits. You got to control the decision making on when you want to sell, if you want to sell, exchange, like refi, all the big decisions. Whereas we have a lot of investors and you can't make those decisions. But like at the same time, it does take a lot of time and energy. And I always say you're going to make the most return on your investment, investing in yourself, investing in your career, in your business, your job, and then outsourcing. Just like now, I'm outsourcing. If I want exposure to VC, I'm going to emerging managers that I like and trust. Or if I want exposure to private equity, I'm going to the same kind of thing. If I want, I'm a real estate guy, so I don't need any other exposure. I'm 90% real estate net worth. But like I think parking the money with a sponsor that you believe in, that could go with you for a long period of time. And we're all young. I started at 24. I'm 30. What am I now? 37 now, and so I've been in it for a while. I've seen a side.
13 years, yeah.
But I've had
tell folks a little bit about. Can you give a little bit of an overview of Gelt? It's a private company, so whatever you want to share. Just be interesting for folks to understand the order of magnitude of what you're doing today.
Yeah, I mean, so current portfolio now is around 6,000 apartment units. We sold around 2,500. I cry every time about thinking about what I sold. Most of it was in Phoenix, which has gone bonkers the last few years. And we also own around 750,000 square feet of self-storage, and we're building around 300 plus units in the LA area, ground up development of apartments. So I try to be zig when others zag kind of thing. So we were buying in Phoenix in 2010, 11 when blood was in the street. We started buying mobile homes 4 or 5 years ago. When before that was really sexy. We exited that space. It was tough to scale. We did really well with it, but there were a lot of smaller ticket sizes, hard to manage. We had to self-manage because there's no good third-party management companies. We're right now contrarian. We're going back to Southern California where everyone's running out of state. We're finding deals locally that have higher cap rates than like Phoenix and Vegas, which historically has been the inverse. Because right now,
can you explain to folks the term cap rate? What does that mean?
Yeah, cap rate is the net operating income divided by the purchase price. So the lower the cap rate, the higher the value of the property. So you want to essentially buy it at a high cap rate and sell it at a low cap rate. And I'd say it's like multiples with companies and stuff. So right now, the multiples are very high in general. So if I'm buying something at a high multiple, I'd rather buy in a core infill location, Southern California, that people are very negative on right now. But I think the pendulum always swings, like and it's very boom and bust these other markets. Like I made a joke, like Inland Empire right now is on fire. I think people are thinking like the west side of LA. I mean, it's crazy. The rents are growing and spiking there, but it's because it's more affordable and it's temporary. I think in the long run, people are going to be coming back into, we bought a deal in Long Beach. We're buying another one in Long Beach, Anaheim, just core Southern California kind of areas. Right now, maybe they're not doing as well, but I think for the future,
what is I'd be curious, just on a personal level, what is your outlook for California? I get asked by friends around the country all the time. I've lived here since 1995. I'm extremely frustrated with some of the politics and taxes and things like that. But, at the end of the day, we've got great weather. We've got incredible places to live. What's your prognosis for California? What do you think happens over the next 10 years?
Yeah, I think, there are some issues, that like you alluded to, but I think long-term, it's a great place for people to live and raise family. And like, you do have a lot of new kind of employers, like aerospace business is booming now here in Southern California. And like a lot of these, like SpaceX and a lot of these kind of newer kind of companies coming, and just, you have the port and industrial and technology businesses and entertainment. And I think I'm just talking about mainly SoCal. NorCal also has some of the biggest companies in the world there. And maybe they're shifting they went from the Silicon Valley area into the city, San Francisco. Maybe they're going out a little more now and work remote. But I think overall California, I'm very bullish on it and long-term. And I think for real estate, it's actually the value of existing real estate goes up more when there's higher barriers to entry. And where people want them, there's so much demand and it's not as much supply kind of thing. So that's why we build in the SoCal area, where it's actually tougher to build and it just takes a lot longer and it keeps people out a little bit. So like, I think, but we are in a lot of markets. We're in Denver, which has been booming for years, continuing to grow like crazy. We love that.
That market's hot, crazy hot.
City, like we're following a lot of tech. I'm sure you invested in companies, Salt Lake City,
Denver and Salt Lake are huge. Yeah.
Portland is another sort of contrarian one with the politics and stuff, but we're doing very well there. We bought in Albuquerque 5-6 years ago. People thought we were crazy, but literally we bought this building for $50 million. It's worth $100 million now. And rents have been spiking recently. We saw that in the pipeline, there's no new development coming on, like literally. And it's been slow and steady, Albuquerque. During the last recession, they didn't have any buildings of size that went REO. So like the highs weren't as high maybe, but the lows weren't as low kind of thing. So slow and steady kind of wins the race kind of thing.
And what's your thesis? So you mentioned self-storage. What's the thesis there? You guys have made a big bet in that category.
Yeah, I just love the asset class. I like any real estate that has a lot of tenants, that you don't have to rely on any one tenant that goes out. And then like in an office building, a shopping center, if you have a major anchor to go, you have vacancy and your cash flow can be cut to nothing or even have to feed the property for an extended period of time. Then you have broker commissions on top of that. You have tenant improvement dollars to spend. So I like any real estate where, and especially self-storage, because you don't have to spend much money over the decades of holding it. It's very minimal, CapEx and
you don't have to paint and carpet.
Yeah, it's like very cheap to run long term. And I think if you're buying in areas that are high barrier to entry or just underserved markets, like we bought in Memphis this deal a year and a half ago that you participated in, and it's fucking crushing. I mean, we literally are hitting our 7-year NOI numbers after a year and a half. And it's the cap rates have compressed like crazy. You have the institutional capital flooding the market, and it's just wild to see. I think with inflation, the costs of reproducing these buildings are just going to keep going up. I think the best, to hunker down and for inflation is just to own real assets, hard assets that'll go up because it costs more to reproduce that asset. And also I like buildings that have rents where you could reset the rent every year, right? On a commercial lease, a 10-year lease with 5-10-year options, like you could be stuck behind an inflation in a big bad way if rents grow faster than your 2 or 3% whatever annual rent bumps you're able to give. So that's why we're contrarian, man. We just bought an office park, a 7-acre office park, but with the long-term goal of redeveloping it. So we're buying great covered land plays right now where people don't see value there. I try to keep.
I think that trend I think is going to be super interesting. There's a enormous mall not far from my house in Pleasanton, and I just drove by the other day and noticed that they were knocking down a bunch of the buildings, and I think they're going to build townhomes. So what happens with all that mall infrastructure, I think is going to be pretty interesting for communities over the next decade.
Yeah, I think definitely a lot of the malls are going to be defunct, and they're going to be scraping certain parts of it, redeveloping it into.
But that real estate is so valuable.
Very valuable. Yeah, that's why you know, yeah, I try to see when the popular narrative is like, oh, retail's dead, retail's dead. I'm like, all right, let me look at retail a little bit. So like, I'm looking at like a strip center here on a huge piece of land that long-term could be a good redevelopment play. So you have cash flow along the way. And these are, yeah, maybe I'd be a little hesitant buying like some of these big boxes, malls, like we're trying to find tenants to replace the vacancy if they go out, whoever goes out. But yeah, there's narrative violations everywhere, man. Like I think TJ Maxx is crushing it now. They don't have much online presence. Home Goods, my mother-in-law loves shopping there. It's all part
Oh
of it.
yeah, TJ Maxx, Target, Dollar Store, Dollar Tree, that whole category is crushing it. Kohl's. Yeah. Yeah.
So like, you know, you can't, I try to listen to what everyone's saying, but then dig in deeper and be like,
Do your own work. Yeah.
yeah, that's where
Love
you make
that.
the outsized returns, I think, just in life, you know.
And buy and hold.
Buy and hold, baby. Long-term hold. Don't sell that Airbnb. I'm gonna tell Chesky, don't sell that Airbnb.
I'm not selling. I'm not selling. Well, thanks, man. This has been awesome. I always learn a ton when I talk to you, and yeah, love being an investor with you, and love the banter on Twitter. So keep it up, and thanks for sharing all your thoughts with folks today. I appreciate it.
Yeah, thanks for having me on the show, Jeff.
All right, man. Take care.
See you, man.